For those of you with a heavy risk portfolio, I have some stocks today that you absolutely want to check out. Hold on to your seatbelts, folks. This is going to be a good one. When it comes to an income-focused portfolio, covered calls have been a staple for many investors looking to create some serious passive income. Their dividend income is impressive, and if the function of your portfolio is to pump out cash, they probably are one of your best options. Some of these ETFs have already been using light leverage. However, in the last year, we have seen the emergence of more leverage on some of our favorite covered call funds. In most cases, this leverage is creating, more income, and how cool is that? There are, of course, risks associated with covered calls, and adding leverage also does enhance those risks a wee bit more. If you have the potential to make 25% more, you equally have the potential to lose 25%. In other words, when things go wrong, they really go wrong and add an increased factor depending on the leverage that ETF is using. In a nutshell, leverage is borrowing money to buy more. So if I buy one share with 25% leverage, they are buying 1.25 shares, and you are getting the benefits of that extra quarter or losing an extra 25% when, of course, things do hit the fan. Join today's conversation. Let me know in the comments if you have any leveraged investments. Thank you for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that click. Before we jump into the ETFs, I do want to add a few points. These are, of course, ETFs that can employ return of capital if needed, and as a result, I do highly recommend that they be kept in registered accounts to remove those tax implications. Additionally, a few of them hold assets that contain ineligible dividends, and thus holding them in a registered account is once again the best way to park these ETFs. I hate to see people pay more taxes than they have to, and registered accounts are the way to go when you want to keep the tax man out of the picture. Without any further ado, let's do this. Kicking off this list at number 6, we have the Global X Enhanced Equal Weight Canadian Banks Covered Call ETF with a ticker of BKCL. This ETF basically invests into BKCC, the non-leveraged version, and they then take on some leverage to buy more. In fact, they use 25% leverage, which means for every share you hold, it can gain or lose at a rate of 125%. As their name suggests, this fund aims to replicate the Selective Equal Weight Canada Banks Index. At the time of recording, their price came in at $18.79. They have an NAV of $18.83, net assets $87.36 million, and their beta fairly volatile, coming in at 1.47. We do not have a return on equity for this one, as they are a relatively new ETF. Their management fee comes in at 0.65%, and their overall management expense ratio, that comes in at 2.59%. You will be paying higher fees on the ETFs we're looking at today, because not only do they have to manage the fund, they also have to write covered calls as well as negotiate leverage. Looking at their dividend yield, that comes in at 15.877%. It is a monthly dividend of 24.5 cents per share. Looking at their returns, on their 1-year return on investment, that comes in at negative 4.38%. Factor in the dividends, we do get a total return of 8.27%. On their year-to-date, their return on investment is coming in at negative 1.36%. Factor in the dividends, we get a total return of 5.07%. This one is definitely not looking super impressive. However, where they're in the banking sector, I am expecting banks to do better as we move into rate cuts, and that will benefit this ETF as well. In our number 5 position, we have the Evolve Canadian Banks and Lifeco's Enhanced Yield Index Fund with a ticker of BANK. They also use 25% leverage as they're investing in the big Canadian banks and insurance companies. Their biggest holdings is actually an insurance company by the name of Manulife Financial. Their current price at the time of recording comes in at $7.44. They have an NAV of $7.38. Their net assets under management come in at $173.56 million, and they've got a beta of 1.25. This one has been around long enough, so we do have a return on equity value, and that comes in at 13.45%. Their management fee comes in at 0.60%, and overall they have a MER of 2.16%. Their dividend yield, that comes in at 15.565%. It is a monthly dividend of 10 cents per share. On their 1-year return on investment, that comes in at negative 1.33%, but we do get a total return much higher of 13.02%. Year to date, that return on investment comes in at 0.68%. Factor in the dividends, we get a total return of 7.44%. So we are starting to see a little bit of improvement with this one. And once again, this is an ETF that will benefit from those rate cuts when they come. Coming in at number 4, we have the Hamilton Enhanced Multi-Sector Covered Call ETF with a ticker of HDIV. They invest in other ETFs to help them replicate the performance of the S&P TSX 60. They do have exposure to multiple sectors, with financials making up 32.5% of their overall portfolio. They also use 25% leverage. At the time of recording, their price comes in at $16.82. They have an NAV of $16.76. Their net assets, that comes in at $408.70 million, and they have a beta of 1.22. Their return on equity, that comes in at 19.04%. Management fee is 0. And that looks fantastic, but there's still a lot of costs behind the scenes. They do have a management exchange ratio of 2.40%. Their dividend yield, that comes in at 10.22%. It works out to a monthly dividend of 16.5 cents per share. On the 1 year, their return on investment comes in at 7.48%. Add in their dividends, we do get a total return of 18.46%. That's not too shabby. On that year to date, their return on investment comes in at 6.52%. Total return 11.27%. As an interesting side note, they also have exposure to gold in the form of an 11.3% stake in their portfolio. So if you love income and you love gold, this may be the ETF for you. Taking our third spot, we have the Global X Enhanced All Equity Asset Allocation Covered Call ETF with a ticker of EQCL. This ETF invests into, EQCC, the non-leveraged version, and then they throw 25% leverage on that to buy even more. They are invested in a globally diverse portfolio of equities for some very broad exposure. At the time of recording, their current price comes in at $21.76. They get an NAV of $21.79. And their net assets under management comes in at $11.45 million. We get a very stable beta with this one of 0.56. We do not have a return on equity, as this is once again a brand new ETF. So they're pretty darn new. Their management fee comes in at 0.75%. Looking at the MER, that comes in at 2.49%. Their dividend yield, that comes in at 10.872%. That works out to a monthly dividend of 21 cents per share. On the 1 year return on investment, that comes in at 8.04%. Factor in the dividends, we do get a total return of 14.90%. Year to date, their return on investment comes in at 6.67%. Adding in those dividends, we get a total return of 11.52%. If you love all equity ETFs like XEQT, but you're looking to pump it up with a lot of income, well, this could be what you're looking for. In our almost top spot at number 2, we have the Global X Enhanced NASDAQ 100 Covered Call ETF with a ticker of QQCL. They invest in, QQCC, an ETF I do have in the 0 to 100K challenge, and they add 25% leverage to it to really enhance those returns. This is an ETF that invests in all of those great tech and AI stocks. Their current price comes in at $22.41, and their NAV comes in at, $22.41. Their net assets, that comes in at $37.82 million, and they have a super stable beta at 0.57. Once again, we don't have a return on investment, as this is also a brand new ETF. The management fee on this one is 0.85%. The MER, that comes in at 2.33%. Their dividend yield sits at 13.333%. That works out to 25 cents per share as a monthly dividend. Looking at their 1 year return on investment, that comes in at 11.11%. Add the dividends, we get a total return of 19.78%. On the year to date, their return on investment comes in at 9.32%. Factor in the dividends, we get a total return of 15.41%. I am very bullish on this one, as I think the AI craze is only just beginning, and that will be very good for tech in general. In our top spot at number 1, we have the Global X Enhanced Oil and Gas Equity Covered Call ETF with a ticker of ENCL. Once again, this is an ETF that invests in, you guessed it, ENCC, and they add 25% leverage to put those returns up into orbit. This ETF is heavily invested in the oil and gas sector, and, well, as this sector continues to do well, so will this ETF. Their current price comes in at $20.72, and they have an NAV of $20.74. Their assets under management, those net assets, they come in at $94.01 million. They do not have a beta or a return on equity value for us, as once again, this is another brand new one. Their management fee, that comes in at 0.85%, and they have an MER of 2.42%. That dividend yield, that comes in at 16.795%, works out to a monthly dividend of 29 cents per share. On the 1 year, their return on investment comes in at negative 5.82%. Factor in the dividends, we get a total return of 3.41%. Of course, oil then started to take off, so on the year to date, that return on investment came in at 11.34%. Factoring in those dividends, we do get a total return of 19.13%. I am bullish on oil and gas, which of course bodes well for this one. These ETFs we look at today do have a wee bit more risk than your traditional covered call ETFs. And for that risk, you are making or losing 25% more. These are not bad options for the income-focused portfolio at all, provided, of course, you have an appetite for the added risk in your risk portfolio. If you are interested in any of these ETFs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on 5 total return stocks you may not know about. Thank you for watching, and I will see you in the next video.